Today, in our preparation for the Series 6 exam, we are covering the taxation of life insurance. This is a critical topic because the tax advantages are a primary reason clients purchase cash value life insurance. Let's start with the most straightforward rule, the death benefit. When the insured person dies, the death benefit paid to the beneficiary is almost always received free of federal income tax. This is a cornerstone concept and a major selling point of life insurance. Now, let's discuss the cash value component during the insured's life. The internal growth of the cash value is tax-deferred. This means that as the cash surrender value increases year after year, the policyholder does not pay any income tax on those gains. Imagine a policy where the owner paid in $50,000 in premiums and the cash value has grown to $80,000. That $30,000 gain is not taxed annually. The tax is deferred until the money is withdrawn or the policy is surrendered. This brings us to one of the most tested areas, policy loans. For a standard non-MEC life insurance policy, taking a loan against the cash value is not a taxable event. This is true even if the loan amount is greater than the total premiums paid into the policy. This is a powerful feature. A policy owner with that same $80,000 cash value and $50,000 cost basis could borrow, for example, $60,000 without triggering any immediate tax liability. However, the exam will test you on the exceptions. If the policy is surrendered or lapses with a loan outstanding, the loan balance is treated as a distribution. In our example, if the owner surrendered the policy with the $60,000 loan, the IRS would consider it a $60,000 distribution. Since the cost basis was $50,000, the $10,000 difference would be taxable as ordinary income. The biggest trap on the exam revolves around a specific type of policy called a Modified Endowment Contract, or a MEC. A policy becomes a MEC if it is funded with too much premium too quickly, failing what's known as the 7-pay test. The moment a policy is classified as a MEC, the tax rules change permanently for all distributions, including loans. All loans and withdrawals from a MEC are taxable. The tax treatment follows a last-in, first-out, or LIFO basis. This means the taxable gains are considered to be withdrawn first. Furthermore, if the policy owner is under age 59 and a half, there is typically a 10% penalty on the taxable portion of the distribution, just like with a premature withdrawal from an IRA. So, if our policy owner with a $30,000 gain took a loan of $10,000 from a MEC, that entire $10,000 would be taxable as ordinary income, and it would likely be subject to a 10% penalty. To keep this straight for the exam, remember this simple phrase: normal policy loans are tax-free, but with a MEC, the IRS gets a fee. This highlights the key distinction. Always check if the question mentions a modified endowment contract. If it doesn't, assume loans are tax-free. If it does, remember LIFO accounting and the potential penalty. This is a frequent source of tricky questions, so mastering this distinction is essential for your success.